We're going to meet with Natalie Howard, who's a partner at AGFE. That's a firm that raises funds in real estate debt. So we'll learn about the alternative lending space, what's driven those changes, why that real estate debt fund business is growing so rapidly, why the banks are being disintermediated, and hopefully learn a little bit more also about how that industry works and where we are in the real estate cycle.
I think that we are where the US were in the early 90s. So we've come out, or the early mid 90s. So they had the savings and loan crisis, and the mass swathes of banks just became bankrupt. And so therefore they had insurance companies then step into that place and build up teams. I think in the same way, we've had the similar thing happen here. We've had banks that have gone bankrupt. And so therefore they've got rid of swathes of people, they have sold off swathes of loans that are non-performing, etc., etc. But that has created a need for alternative lenders, because in real estate is a very capital intensive game, as you very well know, and equity likes to gain cheaper capital to enhance their returns and also spread their equity further. So therefore, what we found was you had the demand from the borrowers, from the property owning market, and that demand simply wasn't being satisfied. So therefore, you had a number of people who came into the market, but came in different forms. So the first form are what we call the liability matching insurance companies. So they are people who have liabilities such as pension payments that they need to make, annuities, where they need assets that specifically match those liabilities. So Aviva is the biggest player in that market. They have a book of about 12 billion sterling. They have always lent in that market, and they lend senior debt that is fixed rate, and it's not prepayable. So it has what we call a spends make whole prepayment penalty.